Thank you. Well, good morning to everyone. Thank you, Arif, for inviting me. This is my first visit here to Abraj Week. I've been invited in the past, never been able to attend, but this spring time works better for me than the beginning of the semester in the fall. I also want to thank Arif for encouraging us to think about the long run and about the possibilities for the future, but without forgetting about the challenges of the short run. So let me tell you briefly what I'm going to talk about. I'd say that there are three basic factors determine returns in growth markets. One is long-term growth, and long-term growth comes from the accumulation of productive capabilities and the ability to implement locally technology, and that involves the ability to create coherent teams of people who know different things in an organization. And we have been able to more or less measure how many productive capabilities countries have and use that to predict their growth. And I'm going to show our projections there. I'm going to say a couple of words on commodity prices, which are an important determinant of growth in some of these countries. And I would like to talk about the relative price movements that caused GDP measured in US dollars in those countries to be very different from GDP measured in real terms. So everybody talks about the rate of growth in real terms of these countries, but that I'll show you is very different from what you might care about, which is the growth of top lines, the growth of GDP measured in your currency of reference, say the US dollar. So what I'm going to say is that long-run growth is easier in countries that have an intermediate level of capabilities and have many potential new industries that they can be moving into, as we describe it in our methods. And that's particularly optimistic about India, Egypt, Thailand, Indonesia, and East Africa, but not so optimistic about Chile, Nigeria, or Kazakhstan, and some other countries in the platform of Abraj. I would say that commodity prices are likely to stay low because of China and because of overcapacity built up through the commodity supercycle. I'm going to say that the gap between dollar GDP and real GDP is huge. It's huge. I'll just show you how large it is. Even at long horizons, even if you average it out over 10 years or 5-year horizons, these gaps are huge and drive a lot of it. So I think they should be part of the investment decision. Where do you want to go? At what time do you want to go into markets? Because this will be a big driver of returns. So let me say a few words on the global economy. I agree with Anshu that the US recovery is here and that monetary policy will have to normalize. I see improvements in Europe. Europe now talks about refugees. It no longer talks about Greece. But I'm going to be a little bit more pessimistic than both Anshu and Arif about China. I think China needs to slow down, and slowdowns often overshoot. Recent policy announcements in China to further encourage monetary easing and so on to prevent the slowdown are really not a solution. And if you want to understand why, this is why. China was growing at 10% per year or so, and it was investing 40% of GDP. And when exports started to slow down, they substituted exports for more investment. And now China has the highest investment rate in the world, not in order to have the highest growth rate in the world, but to have a declining growth rate. So China is just investing too much for the little growth it has. And that means that returns to capital are collapsing. It has invested in overcapacity and so on. And the easiest way to go from 10% growth to 6% growth is through a small detour through -4 or -2, so that you bring investment down to more sustainable levels, and then you can grow. But if this idea of propping up investment so that growth will not slow down too much is a recipe for overcapacity, and you see that overcapacity and deflation in a bunch of markets. So I'm a little bit more pessimistic on China. I believe the story about China in the long run, and I think 6% growth would be fantastic, but just there are too many disequilibria at present. And finally, I think that there's commodity prices will remain low because of China, as I said, because of overcapacity. And now there's a new dynamic that there's a Sunni-Shia split within OPEC. So Saudi Arabia doesn't want to see Iran and Iraq take a larger share of the market. So I think that the dynamic was not there before within OPEC. This is the first time it's here in OPEC, and I think it will affect not just shale oil and so on, but this new dynamic I think will affect things. There's great capacity, it's relatively easy for Iraq and Iran to expand capacity. They need to expand capacity, and there's no space for them to expand capacity. So those are my 2 cents on that. So they've asked me to shorten my presentation, so I won't tell you how it is that I calculate these things, get into my website, the Atlas of Economic Complexity, but this is what we want to say about expected growth for the next decade or so. Extremely optimistic on India, super positive on India, very positive on Egypt and on East Africa. We see that they're ripe for transformation, for diversification. The industries they're in are very close to other industries that they can keep on moving on. More optimistic on Mexico than on South America. Quite optimistic, if you want, on Turkey. And also on Indonesia, Thailand, where you have a footprint. So that's relative to long-run growth. More pessimistic on South America. Brazil has its own sort of like shorter-term basket case issues. Not to talk about my home country of Venezuela, which this will be the worst year in I would say, in Latin America, in any country in Latin America's history over the last century or so in Venezuela. Now, let me tell you my 2 cents on why these issues of dollar GDP versus real GDP are important for investors. You know, if the world was fully investable and you could put money into a country and buy sort of like the index would track GDP. And if you're a dollar investor, it would track GDP measured in US dollars. So I'm going to ask myself the question, imagine that you could buy the index of GDP measured in US dollars and hold it for 5 years. What would your returns have been? Okay, so this is China. The red line is GDP in constant prices, and the blue line is GDP measured in US dollars. And you see there's a huge difference, but China went from, you know, having several years of returns, average 5-year returns of more than 20%, to now having returns of, you know, 13% or so on real growth of, you know, 6%. This is Brazil. Brazil went also several years of over 20% growth in dollar terms, now negative growth. Completely different from the red line, which is real GDP, the one you always, at what rate are you growing? That's the red line. But the blue line is the one that an investor would see. This is India. Again, a period, had a very nice period through appreciation and other dynamics that I'll explain. Very high returns, you know, between 10 and 15%. Now it's more or less tracking real GDP. This is Colombia, again, another country, very, very similar shapes, which means if I take all the countries in the Abraj group, I add a couple of them, Brazil and Argentina. Maybe you want to expand the group one day. From personal interest, I should have added Venezuela, but anyway. So what I have here is the rate of growth of GDP in dollar terms and the rate of growth of GDP in real terms on the x-axis. And the red line is a 45-degree line. It says what would have been the growth rate if both have been the same. So what you see here is that in the period 2002-2012, all countries grew in dollar terms much more than they grew in real terms, dramatically so. The top performers in dollar terms were Kazakhstan, even though the fastest growing country was China, top performer in dollars was Kazakhstan. Nigeria, growing much less than China, was performing at the same rate in dollar terms. Huge rates of growth in Brazil and Argentina, even though in real terms they were growing much more slowly. But in dollar terms, you can get excited by the top line growth. When I look at the subsequent 3 years, 2002, 2015, everybody's dollar GDP growth is now below their real GDP growth, except for China and Kenya and Mauritius. So you see now you have now you see the other side of it. Now GDP in dollar terms is growing way below that stuff. And many of them have very significant negative growth rates in dollar terms. And this is our 3-year average. It's not a 1-year thing. It's a 3-year average already, and significant negative rates. This is comparing US dollar GDP growth in 2012, 2015 to US dollar growth in 2002, 2012. So you see how much the rate of growth of dollar GDP has declined. Everybody's now growing in dollar terms much less than they were before. So there's been a dramatic slowdown of the top line. Now maybe Arif is a brilliant guy, has a lot of alpha, knows where to invest, what parts of the economy are going to grow faster than average, but the average would be growing, has been growing at these rates. Yeah. Right. So 3 minutes, wow. A lot of stuff. So in most countries, relative price changes account for the lion's share of dollar GDP growth. So real GDP growth is part of the story, but valuation changes are huge relative to GDP growth. That red line wasn't changing much relative to the blue line. And what drives the blue line? Well, several things. One is the direct effect of the terms of trade on dollar GDP. If the price of oil goes up, and you produce the same amount of oil, real GDP has not gone up, but the dollar value of your GDP has gone up because your exports are now more dollars. And secondly, if your dollar exports go up and so on, or capital inflows, you get real exchange rate appreciation. So your sales are more or less the same, but in dollar terms they go up because of valuation changes. And so here are for the countries in the Abraj Group basket, and the ones that I could get data for both terms of trade and real exchange rates. You have some of them in the period 2002-2012 had humongous increases in the terms of trade, Nigeria, Colombia, Chile. Now you might classify Nigeria as a consumption-led country, but consumption implies imports, and imports have to be paid, and if you're not exporting something with which to pay the imports, forget about consumption-led growth. So these countries had significant terms of trade improvement and significant real appreciation. Not so, terms of trade deterioration in this period was Singapore, China, Philippines, Pakistan. They were having to pay for higher oil prices. So real exchange rate appreciation is driven by the indirect effect of the terms of trade. Your terms of trade improve, now you feel richer, you spend more, and domestic prices go up. Capital inflows allow you to finance current account deficits that are more significant. You spend more money domestically, and that drives real appreciation. And temporary macro disequilibria, situations that are going to be unsustainable. So these things tend to be mean reverting. So I've tried to calculate how much overvaluation was built in by 2012. Before the reduction, and the countries that were sort of like poised to normalize. And you see a lot of these countries have now been delivering negative, say, dollar GDP growth rates. So summing up, commodity exporters with low complexity and low diversification potential will face an uphill battle. They need other exports, but it is challenging for them to get them. It's hard for Zambia to diversify out of copper. It's very hard for Nigeria to diversify out of oil. And if oil is not going to grow, it's hard to see how you make Nigeria grow. Even if they have good demographics and urbanization, growth will be limited by the external constraint. Sometimes you see these economies growing a lot, you get very excited about the growth in domestic consumption, but you should not forget the external constraint. How are that consumption going to be supplied with imports, and what is going to be paying for those imports? If there's a dramatic change in the dynamics of exports, there is no such thing as consumption-led growth.
Thank you so much.
Yeah. And finally, non-commodity exporters with favorable complexity are bound to do well. And I repeat the name of the countries that I mentioned before that I see to be well poised for growth. Thank you very much.
Thank you. Whether you measure GDP in real terms or dollar terms, what really matters is the quality of growth. I think we can agree. I'm going to turn now to Philippe. Chile was one of the big beneficiaries of a Chinese growth model, which was resource intensive, commodity intensive, manufacturing, industrial production intensive. Many people think that growth in China accounted for fully half of world growth over the past decade and a half. Philippe, give us a portrait of Chile through the last decade and a half as an example of how the rest of the world benefited for China's voracious demand. Thank you.
Well, thank you. First of all, I'd like to thank Abrash for this invitation. This is my second time at this event. I was in Istanbul before, and I'm happy to be here again, here at Dubai. Let me say, Henny, a couple of things. I prepared a few slides on this issue of China, but beyond Chile. And when I got here, the first thing, I'm from Chile, you know, I work in Chile, I'm a native Chilean. The first thing I see in Ricardo's presentation is he's very pessimistic about Chile, you know. So I must respond quickly. Ricardo, you have been pessimistic about Chile for the last 10 years, and you have been wrong. And we're going to prove you wrong over the next 10 years if you give me a bit of time. But anyway, including going back to government, which is one thing we will try to do. Anyway, let me see. China is a major force, as we know, in the commodity markets. But if you look at the different, part of these comments will be based on the fact that I come from a region which is highly dependent on commodity, which is the Latin America. But I'm going to be drawing a few analogies with this part of the world. If you take any kind of, you know, let's say copper, which is very important for us in Chile, half of our exports are copper, and it's 50%. Almost 50% of 45% is China. So we are dependent on China. If you think of exposure to China, I put here a few of the countries, and you can see that Chile is the third that I came up, Oman being the first. Just this is direct exports to China. Chile's exports to China, 25, we're about as dependent as Korea on China. And if you look in Latin America, there comes Peru, Brazil. So there's a lot of dependency in Latin America on China. Let me just say that it has to do with the fact that we are extremely dependent on commodities. This is a region that is sort of commodity dependent. In many parts of the region, we can also say that we have the consumption economies which are dependent on commodities. So it's not, you can put it as different categories, but we have countries where consumption has been growing strongly based on dependence on commodities. I would say from Latin America, from the main countries of Latin America, there is only one country, Mexico, that has relatively low dependence on commodities. And oil in Latin America, important for some countries. You see Venezuela being the most important. Ecuador, Colombia, all the rest of the region has benefited from the decline and the collapse of oil prices. But of course, we have not benefited. We have been down-driven by the decline of copper and others. But in some cases, the terms of trade, which measure the price of export to imports, have been pretty stable. If you're a very large importer of oil and you are an exporter of copper, let's say, you're pretty stable on that. My last point is that a lot will depend, how countries will do, a lot will depend on their fiscal position. The net public debt of some countries here in the region, you can see the UAE where we are, minus 267% of GDP, of course, because there's a very low level of debt and a huge sovereign fund. So the difference here is whether you are a very large debtor, and we have countries in Latin America that did not use the commodity cycle to increase their stock of sovereign funds or their net assets to build a cushion for the time when commodity prices would come down. I would point a difference here, and I would also make a point about the Pacific Alliance. Maybe we'll have some time later to talk about the Pacific Alliance. In general, Pacific Alliance countries, meaning Mexico, Colombia, Peru, and Chile, are countries that have better fiscal positions, that have accumulated little, but they accumulated some sovereign funds, and they are better able to respond during the downturn. So when you look at growth averages for Latin America, you would see Latin America is growing at 0. But here is where the averages, really will be misleading, because it's growing 0 because Brazil is in the deepest recession since the 1930s. And you have a few countries that are growing. They're not growing tremendously. They're growing at 2 to 3%. These are Pacific Alliance countries on the Pacific. And you have a country like Argentina. You have Venezuela in a deep crisis. And you have Argentina also growing close to 0 with some better prospects. So looking at averages are misleading in our region. And I think there are very interesting prospects. My last point is on macro and micro. We will discuss more about this, and it has been said here that, well, the macro is not so important. That it's really important is the micro. But I would say here that the micro is likely to go much better when the macro is right. Thank you very much.
Philippe, thank you so much. Excellent points. And you can even look within a country and say in Mexico, northern Mexico, closer to the border with the U.S., is doing better than southern Mexico, to your point about geography. I will now turn to you. We have just had an image of China supporting growth, but now we're in a different world where China is moving to a much less resource-intensive phase of development, depending much more on consumption, less on investment. What are the consequences for the rest of the world? Is this a bad thing for the rest of the world, this different template of growth in China?
I would say it's bad for some and it's good for others. First of all, about China, a few things for us to think in terms of how prolonged the change might be. I remember recently hearing statistics that in the past decade, China has poured more concrete and cement than the United States did in the entirety of the 20th century. And that pace clearly cannot be sustained. So I think Arif is correct that growth in China in the future will come from the new side of their economy rather than from the old side of the economy. And even in my industry, we already are seeing this, a much greater interest in China in investment in human capital development and acquisition of information, intellectual property. So, the change in China's economy is serious. Secondly, China faces, I would say, some significant externalities, most clearly the issue of environment. And it has to, the climate deal with the US, climate deal with Paris. Some of these are going to push the Chinese economy in particular directions, so its slower rate of growth is also going to be mandated by this. I mean, if you looked at
But do you think the quality of growth improves even as the quantity of growth slows?
Well, that remains to be seen, largely because the old industries basically cannot sustain the rate of growth. The question is whether China can successfully transition to a new economy to be the engine of growth in the right time. And the third factor is China's government. I mean, the Xi Jinping factor will fundamentally change the way in which the command economy in China worked. And that we don't know how it's going to appear. Right now, shift to consumer consumption is more of a talking point than a reality. So that remains to be seen. But there are two other issues that I think speaks well for the rest of the world. One is that China is now investing in exporting its excess capacity. It's investing in Africa. It's investing in South Asia. This idea of one belt, one road essentially means that China wants to sustain its internal growth by investing in other countries. So you look at a country like Pakistan, they're putting $46 billion of investment into Pakistan. Mostly is export of coal plants, varieties of other Chinese products to Pakistan. Whether this is a good deal economically or a bad deal, it will create a lot of jobs in Pakistan because roads are going to be built, infrastructure is going to be upgraded, electrical grid is going to be fixed in Pakistan as a consequence of this. So it's going to have a material impact on the economy in Pakistan. And finally, there is wage hike going on also in China, and that will create opportunities for countries like Vietnam, Bangladesh, Philippines to essentially to begin to grow on the back of shift of low-cost jobs from China to these countries. So I think it's going to be a mixed bag. There are going to be losers in China's slowdown, and there's going to be winners in China's slowdown.
These are great points. Thank you so much for that nuanced view. And, I think you're so right that countries will benefit, but in a different way. And if you can take advantage of the capital exports and the excess capacity exports, you will be in a great place. So, I spend so much time in Asia. The average speed of a freight train in India is 25 kilometers an hour. I go between Shanghai and Beijing on a train that goes 300 kilometers an hour. Dimitris, I want to turn to you now and go back to kind of Philippe's points about how do you diversify your economy if you have depended largely on commodities, possibly even a single commodity export to China? How difficult is it? What are the case studies of the few countries that have been very successful in diversifying away from commodities? And are there countries, as Dr. Hausman suggested, who are incapable of doing so?
Well, thanks. Thanks also to, first and foremost, to Arif and Nabraj for inviting me here. I think I would take it on the commodities, I would go beyond China. I think in general and I think as Felipe put it up on the slides here, I think you see the dependence of many countries on commodities. I think he used the good example of Mexico, and Mexico has done well on getting away from commodities. I would use another example, which maybe he will disagree with me on it, which is Chile. Chile has also developed an agricultural sector, which perhaps doesn't represent so much as a percentage of exports for Chile, but it's a strong export sector for Chile, and it's created some diversification, I think, from the country. But what we see, and I can say, speaking for myself, but for IFC, but also we can look for what my colleagues at the World Bank say, is the challenge here is for policymakers is to direct activity to new sources of growth. I think this is a big challenge, and that in many ways will be achieved in my mind through structural reforms. I think and Arif talked about it, and maybe I'm not as pessimistic as Ricardo, for example, for a country like Nigeria. I think domestic growth can take up a lot of the weight from the exports and the reliance on exports of commodities. Thing is, you have in places where some of the larger countries, they have the advantage compared to the smaller countries on creating this diversification. But what we think is, the first thing is you need to create an environment that removes the infrastructure bottlenecks. And you also need to create a dynamic and innovation-friendly business environment. I think that's key in many ways from a lot of these countries. Last but not least, I think is what has happened is in many of these countries what we see is because the commodities have played a role of, have limited the human capital of these countries. So what you need to do is to bolster the human capital of these countries, and you bolster it through reforms in areas like education, in areas like labor, and also in product markets. I mean, these markets have to open up, and I think a lot of these markets have to open up. I mean, another example that's been successful in many ways, and I think Arif talked about at the outset, is UAE, where, in UAE they've done quite a lot to decrease this dependence on commodities. It's easier said than done, I think, a lot of these challenges, but what we see going forward, this is the opportunity. I think another thing that something that you see a lot of these commodity exporters, and especially the ones that are on the oil and gas side, is the elimination of subsidies. The eliminations of subsidies will enhance the commodity competitiveness of these countries and will create also the incentive for creating manufacturing, potentially other sectors that could be source of export revenues.
Thank you so much. One of the theses that underpins Abraj's investment philosophy is the growth of consumption, and particularly in urban areas. And I think that one reason I'm a little more optimistic about China than you are, Vali, is I was in Shanghai just before Chinese New Year, and I went to see the logistics center for one of the e-commerce companies in China outside Shanghai, JD.com, Jingdong.com. Workers there earn 6,000 renminbi a month. That's almost $1,000 in US terms. So in other words, if you work in a logistics center, you are paid far more than you would have been paid working in a low-end garment factory in the Pearl River Delta. You do see income growth in China, and it is largely in urban areas. But Vali, I look at the rest of the world, and certainly in developed markets, you don't see much income growth for a middle class. Is the outlook for income growth in emerging markets better? And what do we do to make sure that trajectory continues so there isn't a backlash against income inequality, against globalization, against technology? How confident are you that we will see workers' lives improving, that consumption will be underpinned by real growth in wages in emerging markets?
Well, first of all, I'm not pessimistic about China. I just think that we've gone from a period of being absolutely certain there's only one kind of China, which is growing at a certain pace and it's all good news, to treating China as a real economy. In other words, it's going to be complicated, complex, with different parts to it. I think perhaps context here matters. In other words, there's not one size fits all. Despite the overall numbers we look at, in many cases, when you look at either countries or cities, as I think Abraj very appropriately puts emphasis on, there's a set of other factors that matter. For instance, the size of private sector, the empowerment of the private sector matters. And actually, one of the interesting things to see is that where we are in the current macro circumstance will actually push for more privatization in particular markets, and that will have an impact. Secondly, government dysfunction is actually not a bad thing. It actually is a source of growth, because a combination of private sector ability with the fact that the government is not delivering services actually creates growth areas which sustains the middle class. It actually provides an engine of growth for them. I mean, education is a very good example. Private sector education has been exploding exactly because there's a middle class demand for education, but the government is actually unable in many places to actually provide for education. So companies like GEMS, who grew out of UAE, have actually been exploiting these sort of crevices going forward. And I think cities sort of accelerates this trend, because not just because cities provide scale, as Ara very appropriately mentioned, but also because cities bring a combination of much more relaxed regulation, human capital, and finance together. And as a result, those combinations, if they work in right ways, provide, if you would, niches in which you can have continued growth of middle class. Even in the case of China, there are pockets within China where particularly in the services sector, that you're seeing actual growth, you're seeing investment, you're seeing job creation. Where China is not doing very well is exactly in the old side of the economy, where competition for wages and environmental restrictions may give a very different picture. So I think, again, looking at the broader picture, we're going to see losers and we're going to see winners. But I have no doubt that the driving force is going to come from where you have a cluster of middle class that is actually capable of taking advantage of these opportunities to provide economic growth.
I think Vali was so right to emphasize the human capital. Can you talk a bit about Chile and whether the educational system in the countries of South America is helping to contribute to, you know, the skills necessary to succeed in a digital world rather than an analog world. So this is one reason why I'm so pessimistic about Japan. That society was the perfect assembly line analog world society. But talk a little about the young people, the human capital. You know, can the private sector step in, have a role there? Is it up to the government?
It's a combination of things, but I would say first that there has been very significant progress. I'll talk about Latin America in general, Chile in particular, in terms of increasing the rates of enrollment in education. We have virtually, in Chile and in many countries, going to universal primary education. We didn't have this some time ago. So going to almost 100% primary education and secondary education, increasing the numbers in tertiary education, higher education, to about, right now in my country, about 35% of the population within that age is going to an institution of higher education. This is up from, let's say, less than 10%, a couple of decades ago. So there is a movement. I think that in terms of enrollment and in terms of coverage of education, we're doing significantly better. Then comes the issue of quality. And in the issue of quality and on the training, what kind of things are you looking in tertiary education? For example, we have, in general, for the region, we have a few institutions of higher learning, universities, which are, world class, but they're only very few. True, some of our, brightest guys go and study abroad, but we need to develop that kind of quality within our countries.
Philippe, do those students come back to Chile?
Yes.
That's the key question, right?
Actually, they do come back to Chile. Interestingly, and this, we have all the statistics, but the typical thing, two grad students, which, I had a few friends, in grad school from Latin America, and we were classmates, and typically the Chilean will go back, and the Argentinian would say, no way I'm going back. So, I mean, there was some difference between different nationalities. But let me just add one thing, if I can, to a comment that was just made on China and the issue of the change and whether we are pessimistic or not. There is an important disequilibrium in China right now. Consumption, when you say consumption is 34-35% of GDP, that is a complete disequilibrium. You can't have a country with that kind of consumption numbers. Consumption needs to grow. So that's this change to the service sector, this transition to a more consumer-based economy will happen in China. It will be good for China. It will be very good for the rest of the world. Maybe China will grow less. Maybe some of the commodities that it's consuming now will be consumed at a lower rate. So I think that the commodity price change has been structural, not just a cyclical thing. But in terms of agriculture, and I take your point, Dimitri, in terms of the demand for foodstuffs and agricultural goods, I think that would be a tremendous source of growth. And I will finally point to another very important source of growth, was mentioned in the previous panel, in financial services. The combination of technology and rising incomes means that a lot of people are coming and demanding financial services. And they will be able to come and it will be a monumental change in their well-being. But that creates a lot of opportunities for companies and financial companies who are attending those needs. So I think that's a very important growth sector in emerging or growth markets.
Thank you. Before I turn to you, Dimitris, with a question that you have not been prepared for, so forgive me, I just want to make the point that, Ari spent a lot of time talking about refugees and migration out of stress. But, when I see, for example, the FT, my company's driver in India, he came from a remote area of Bihar. And now he's the driver for the FT in Mumbai. And maybe it's not a great life, but his 14-year-old son speaks English, studies computers. He will have a wonderful life compared to his father, an infinitely better than his grandfather. So, Dimitris, the question for you is it an advantage to be an emerging market today in that you can leapfrog? You don't have legacy systems. You can have all kinds of new models. Is it a good thing? And are there investments that the IFC has made that would underscore that kind of trend?
In some ways, this is the debate. And it's a debate that a lot of people have on whether many of the other emerging markets are going to follow the China model, which is a growth with a heavy emphasis on manufacturing, or they're going to leapfrog this model and use technology to go to the next level. I think it's still, the verdict is still out. I think what we see is there are still places, in particular in East Asia, that they have this competitive advantage of manufacturing. They still depend on the links to China, and I think their manufacturing is going to be an opportunity. But on the other hand, what you see is, and I think I'll pick up on the last point, and I think something that Anshu talked about as well, fintech. I think there you have quite a lot of models where there is change, and there are more opportunities are created through the combination of financial skill, provision of financial services, and also technology. M-Pesa in Kenya is the first and the good example of using a distribution channel using mobile telephony. And I think we see more and more of these things. I think the other good example, you talked about e-logistics in China. And e-logistics in China, in many ways, they play a role in transforming the China inner country. I think as some of the remote areas of China, what we see today and using some of the Alibaba models are being, and the Alibaba distribution channels and other channels that you talked about, they are being transformed. So I think as technology can provide, we think an opportunity in many of these countries to go to the next level. And I think that it's, you avoid with, especially places where they don't have the hard infrastructure. So that the thing is the opportunity there.
We are going to have one or two more questions, then 5 minutes of questions for you, and then I'm going to wrap up and come back to the whole macro-micro thing. So, Vali, Arif had talked about geopolitical risks in the world, and I think all of us who live in a financial world are painfully more aware of geopolitics as a factor now. The world somehow seems more dangerous. What are the geopolitical risks that you are most concerned about?
Well, one is, I would say, is scale, and also is the number that are happening at the same time, which could actually have a systemic impact. In other words, the world can handle so many significant geostrategic problems all at the same time. And then I think the leadership issue, as was mentioned in the last panel, is also important. So until the presidential election in the U.S. is settled, there's an ambiguity there. There's ambiguity now in Europe, largely because some powerful leaders have been weakened, most notably Angela Merkel, as a consequence of the refugee issue, and that will play out in all sorts of things within EU. You have a significant change in China, which has put to question the direction of the country. So these things come together in a significant way. But in particular, events in the Middle East, war in Syria, and also the refugee crisis that it has created, create, if you would, a great deal of uncertainty internationally. Wars and destruction and conflicts, whether it's in Ukraine, in Syria, in South China Sea, are always bring risk to economic factors. We also are dealing with some longer-run sets of geostrategic issues which sort of cross over into economics, including climate change sets of issues, global healthcare risks, global food security risks. And then the refugee issue is actually much larger than we see it, because this is something that's going to be with us in an ongoing basis. I mean, one estimate is that by 2050 in Africa alone, there will be 10 million refugees from climate as the Sahara begins to move further south. And we really don't have a system to deal with these things. Now, the easy part is always to sort of create a very direct correlation between geostrategic problem and economic downturn. And that's usually the case. But when you look at it from a business side, it doesn't always track that way. I mean, we have to sort of be able to explain why a country like Pakistan, which has been racked by war, terrorism, all sorts of instability, we only see one sort of headline about it, is actually a middle-class growth success story. It's the best-kept secret in the business world. Every major multinational corporation is doing extremely well on the back of a middle class in Pakistan. So the question is, how did Pakistan end up creating a middle class in a situation of war and terrorism and instability? Or you look at it, the next sort of maybe major global growth market to come online, Iran. How did Iran actually expand its middle class when exactly all the international and economic indicators were negative? Actually, under severe sanctions, the middle class actually grew. And that suggests that for economists, the question is different than for equity investors or businesses. In other words, they're really micro level at particular markets matters. I mean, again, Nigeria that Arif spoke about, if you looked at it from far away, Nigeria is not a sort of a political success story. It's got terrorism within its ranks. It has got a lot of government dysfunction. There are severe rebellions around equity issues, and yet it's been able to create a middle class that is an engine of growth. If not for the whole economy, it's an engine of growth for businesses that invest in that middle class. And that might be something that we should sort of separate.
Thank you so much.
I think Ricardo has it.
Yeah. I'd like to respond to two statements. First, when we think of a developing country needs to import a lot of things that it doesn't know how to do. And it will have to pay for them. So you can have a lot of domestic growth. It has to be, the balance of payments has to be financed. And most developing countries stumble in not being able to create domestically goods that the rest of the world is willing to buy. So some of the growth and some of these ideas that, Africa rising and so on, happened at the time when suddenly the external constraint on these economies was lifted so that there could be a lot of domestic growth. So we can never lose sight of the fact that these economies need to be able to generate foreign exchange to sustain their growth rate. From that point of view, I don't see how you can be optimistic about Nigeria. Nigeria, 98% of their exports are oil. Oil is down. Volumes are not growing. Domestic consumption is rising. There's very little transformation, except for Nollywood and very few other things. The rate at which non-oil exports would have to grow in order to maintain a decent growth rate in Nigeria are just astounding. So telling Nigeria, focus on domestic consumption-led growth, is putting the accent away from the challenge that they really have to figure out what are the things that they could make in Nigeria that the rest of the world would like to buy.
Thank you. We have time for one or two questions at most. Right there, thank you so much. Is there a microphone? If not, please bellow. Great.
Yeah, thank you. My name is Bolt.
Make it brief, please.
I'm from Mongolia. One of speakers mentioned about the Xi Jinping factor on the, I hope it was on the crackdown on corruption. So how do you see what would be the long-term effect where China is transforming from production country to consumption country, and how far and how successful these new developments which affects the everyday life in China significantly? Thank you.
Wale, do you want to take that?
Corruption or quality? Was it about corruption? Yeah. Well, very shortly, I mean, definitely less corruption is better for business, but the key question in China is the extent to which this is about power consolidation as opposed to being actually truly about an anti-corruption movement. But in the short run, it actually has been somewhat destabilizing because it's made decision-making in China much more difficult on a host of issues.
That's a perfect answer. There's a political risk in China that didn't used to be there when you look at any company. Yes, there. Thank you.
There's
I just want to harp on the geostrategic and geopolitical things. There's one angle which is like India, Pakistan, Afghanistan, Iran, China. How do you envision the water and agricultural management in that region? Because there are pockets of so many issues surrounding around these two things.
That's an excellent question. Who wants to take it? Demetrius?
I'm not an expert on.
Well, you know, again, there's if I'm correct, you said there's a lot of political issues, right? Well, again, not all of these countries are in an identical situation. You know, Iran, at least geopolitically, looks a lot more positive than it did 10 years ago after the nuclear deal. India, of course, is also much more engaged. The interesting country in the middle of this is actually Pakistan. And Pakistan's, I think, you know, political scenario is still very unstable. The terrorism issues still are unresolved. It still has a nuclear standoff with India, and I think, to Ricardo's point, some of its macroeconomic issues are also unsettled, and the direction of the growth of the country is not yet determined how it's actually going to achieve economic growth. Yet, within that, there is a very robust business environment built on the back of a middle class, which is anywhere between 25 to 40 million people. And you know, again, it looks like the question is, you know, are we looking at business opportunity, or are we looking at economic and political stability and growth? And these two things in Pakistan, I don't think are aligned together. I mean, you know, Pepsi every 2 years reaches maximum capacity in production in Pakistan. For Nestle and Unilever, Pakistan has been one of their most profitable Asian divisions. And these things don't track with the overall picture of Pakistan.
Thank you. Final question to you. Thanks.
Hi. My name is Ahmed Jalal in Abraj, Global Healthcare Fund. So I'm going to take permission to quote Karl Marx in a private equity conference. So Karl Marx's criticism of capitalism was, in drive for efficiency, capital will replace labor, leading to a huge level of unemployment in a society and eventually civil strife and chaos and everything. And what we're seeing in the US politics is an example of what Marx had predicted, is that jobless recovery, real wages coming down. I think this is going to be a phenomenon across the world that's going to happen. So when we talk about winners and losers, I don't think there are going to be any winners. I think we're all going to lose in a society which is going to be polarized if we don't think of integrated or interdependent, inclusive models of growth. And I think that's the biggest challenge for us, is to look at ways how the trickle-down concept actually becomes a reality, and the wealth goes from the top all the way down, because otherwise we'll all be losers.
And I think that's one of the reasons that Arif talks about local communities as being stakeholders for Abraj as well. Unfortunately, we are over time. I just want to end on one personal note. I said this was a labor of love for me. Like Vali, I spend a lot of time in Pakistan. And I was fortunate enough to visit one of the Abraj companies, which is the utility for Karachi. Arif and his people put $1 billion in CapEx in this absolutely dysfunctional utility where more electricity was stolen than was sold, and now the EBITDA is 400 million. Thank you so much for your attention, and thank you for my panel for making this such a pleasure. Thank you.